Hey guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So we're gonna go ahead and do a mortgage rate update. We're also gonna be talking about how mortgage-backed securities took a no bid. I know this is a little bit already happened, but this is my birthday, it's Father's Day. It's a little backlog, but I think it's still important to go ahead and talk about it. And we're gonna do a comparing and contrasting of what happened as far as overvalued home prices in 2007 versus now. And how do they correlate with one another? Because let's just face it, you can't know what's going to happen in the present without referencing something back in the history. We're also going to go ahead and talk about mortgage products and how the mortgaging system is a little bit flawed. Now, I know as a 20-year mortgage broker, I shouldn't be saying that it's a broken business, but I think there's different ways and avenues that we could go to mitigate risk, to go ahead and make the approval process a lot easier and more streamlined, and this way we could kind of counter all of this bullshit that we're in right now. But let's go ahead and go with the mortgage rate update and how it all correlates with one another. As of 6/21/2002, we're going to be pricing out 5 different mortgaging products: a 30-year fixed, a 15-year fixed, a 30-year FHA, a 30-year jumbo, and a 5/1 adjustable rate mortgage. And if you don't know what a 5/1 adjustable rate mortgage is by now, it is fixed interest only for 5 years. Then it gets adjusted every single year to the cap and the rate on your product. 30-year fixed will be sitting at 6.07% as of today, 6/21/2002. That is 0.04% increase from 1 day ago, 0.21% better pricing than 1 week ago, 0.72% increase in pricing from 1 month ago, and 2.82% increase from 1 year ago. 5.44% on a 15-year fix. That is 0.07% increase from 1 day ago, 0.01% better pricing than 1 week ago, 0.66% increase from 1 month ago, and 2.82% increase from 1 year ago. 30-year FHA will be sitting at 5.58%. That is 0.02% better pricing than 1 day ago, 0.17% better pricing than 1 week ago, 0.58% increase from 1 month ago, and 2.83% increase from 1 year ago. 5.15 on a 30-year jumbo. That's 0.1% increase from 1 day ago, 0.1% better pricing than 1 week ago, 0.41% increase from 1 month ago, and 1.98% from 1 year ago. 5/1 adjustable rate mortgage will be sitting at 5.38%. That is 0.05% increase from 1 day ago, 0.12% better pricing than 1 week ago, 0.86% increase from 1 month ago, and 3.1% increase from 1 year ago. And that is going to be your mortgage rate update. Now, a lot of people, especially myself included, we thought it's going to be a crazy debacle of a situation when the feds hit us at a 0.75%, 75 basis point increase as of last week, which our next one is actually going to be on July 27th. So we're going to go ahead and stay tuned with that. If you want to keep yourself up to date, just go ahead and like, subscribe, comment, and you can go ahead and get into all of that. Wait till I go ahead and update that. So the reason why the interest rates have not increased as of yet as much as we anticipated to, because we were anticipating it to go into this crazy realm, and the reason why it didn't is because the MBS, which is mortgage-backed securities, which is the thing where your mortgages go into, had a no bid. So the MBS went no bid, and it goes to show you that nobody was ready. So what does a no bid mean? When you have a mortgage, right? When you have a mortgage, your mortgage gets dumped onto the portfolio of your depository institution, which is your bank, your JP Morgan Chase, your Wells Fargo, whoever else that you might have, right? So when you have those people, they don't want to hold on to the individual mortgages. They're like, cool, we got it. Dump it to another servicer, and that is going to be on a mortgage-backed security. That is going to be in the secondary market. Another person is going to go ahead and service that loan because they're going to make money off of the interest depending on how long they end up holding it. If nobody is buying it, that means that, in a nutshell, I went ahead and wrote some notes down, so I will go ahead and explain it because I didn't want to miss anything else out, okay? So banks lend money to people to buy property. Most banks don't want to hold individual mortgages because they take a long time to mature. They can be risky, and they would rather have cash now to make more loans. Okay, so mortgages get bundled together and sold off as mortgage-backed securities. It's just essence a bond. A bond is just a debt. A debt is something where people go ahead and buy in a secondary market because they make money off of the servicing. Now, they sell these off to other investors. The bank sheds those mortgages because they're a depository institution for the most part, where you have your big boys, right? They don't want to hold this debt on their books. So what they want to do is they want to go in and leverage more available funds that they have, and then they get to go ahead and sell it off to somebody else. So like if you and I, right? You and I, we're sitting here, we're chit-chatting, like, dang, I lent Jim $1,000, but I need to go ahead and buy this property for $5,000. I need to go ahead and get my 20% so I could go ahead and use the leverage to go ahead and get another loan out. If I don't have the $1,000, then I can't. The bank sheds the mortgages to get their money. Investors with longer investment horizons to get collected from profit from mortgage payments that come in every single month. If there are no buyers on the MBS, then the banks have to hold individual mortgages, which they hate. They don't want to do that. If banks have to hold individual mortgages, they have to be careful with risk mitigation. They have to be careful with how much they go ahead and lend. Things become more stringent, and then in the mortgaging industry, in the industry I am in, we end up having more overlays. So even though Fannie Mae, Freddie Mac, FHA, VA, they have their guidelines on how we go ahead and lend, depository institution, wholesalers that we sell as mortgage brokers, they end up layering more risk mitigation on top of each and every single loan to go ahead and counter the available long-term risk that they might have, because we are anticipating, let's just face it, we're going to anticipate that we're going to get somewhere in the 7.5% to maybe even over the 8%. And this actually has happened before. This happened, and I've said it 1,000 times. This is something very similar to the Volcker shock that happened back in the late 70s, early 80s, post-Vietnam War, because we're trying to counter hyperinflation. This shit has happened already. This shit happened we could just look back at history and we could see exactly what happened. But if banks get tighter in their lending, mortgages will become much more harder to obtain. If mortgages are harder to obtain, fewer people will qualify to buy, and liquidity does dry up. Now, that's why the no bid correlates with the current real estate market and the mortgage-backed securities. So you see how real estate and the stock market, they're so closely correlated, because look, this is a house, this doesn't mean shit. This means nothing in the grand scheme of things. This is just a vessel to go ahead and use it as an investment for you to go ahead and have the banks sell you money. It's just a house. House doesn't cost that much to go ahead and build. It's really not that bad. The labor costs a lot, but building a house is cheap as shit. It doesn't cost much of anything to go ahead and build a house. But that's how it go ahead and correlates. Now, the best thing that we could do is we could go ahead and see, okay, now we know what's going to happen as far as interest rates. Interest rates are increasing. We have to counter hyperinflation. We have to now look, now that we know what interest rates do and where interest will end up going because of the Volcker shock, we know exactly that the mortgage-backed securities in the secondary market is not trading. It went no bid. Nobody fucking wanted to buy these goddamn mortgage-backed securities. They said, fuck it, we're not going to do it. We're not going to touch it. Now what we could do is we could go ahead and look and see what the last catastrophic housing crisis happened back in 2007, right? So in 2007, we ended up towards the end of it having a bunch of overvalued properties. Now what I'm gonna go ahead and do is I'm gonna go ahead and pop up right here, flash it up, 2007, the degree into which regional home prices were overvalued and undervalued. So you see that there was only one undervalued place that was somewhere down, I think it's like Louisiana or something, on the bottom right hand corner, right west of Florida, but everything else for the most part, as far as your high metropolitan areas, your Californias, your Floridas, your New Yorks, and certain pockets, Midwest, your upper west side, those are all little overvalued. Now I'm going to go ahead and pop up 2020. 2020, the degree to which the regional home prices were overvalued or undervalued in 2020. As you can see, it's kind of like not that bad. Los Angeles was still undervalued. A lot of the big pockets were pretty much undervalued. There's some places over there in Arizona and New Mexico that were potentially overvalued. Idaho is a little bit overvalued. Now let's go ahead and take a look at the comparison of what is overvalued as of 2022. Looks shockingly similar to what we had in 2007. if I could put it side by side right now and I could figure out how to work this editing thing, I'll go ahead and put it. But I'll just do a flash back and forth, back and forth, back and forth. It looks remarkably just like 2007. Reason why all of this is so drastic is because you also have to take a consideration. So now we have interest rates. We have banks not buying anything. They're tightening, they're becoming more stringent. Now we have to see the buyers. Buyers, how long will a buyer take to go ahead and save up a down payment to go ahead and get into their first property? Now I'm gonna go ahead and pop it up. To get 3% total down payment, now there's anywhere between $9,000 to $20,000. Total cash required will be about $20,000. The normal average American takes about 8 years to go ahead and save up enough money for a down payment, because you still have rent, you have your running costs, you have car payments, you have kids or whatever you have all these other things. So you have to save up 20%. To get 5% will take you 11 years, to do 10% would be about 17 years, and to do a 20% down will typically take 30 years. That's about $73,000 to $80,000. Typically in California, we're about $200,000, we're about $250,000, a little bit somewhere around there to get 20%. So you see how all of these kind of correlate with one another, and kind of puts us in a really, really shitty situation. But if you want to stay up to date as far as mortgage-backed securities go, the current real estate market, oh shit, I totally forgot. We didn't even talk about the mortgages. Now what we're going to go ahead and pop up is we're going to talk about the increase in total mortgages that increased as far as $150,000 and or above. Before we had $10,000 to $70,000 loans, how they've completely went to shit. You can't do anything. $70,000 to $150,000, those completely decreased. And we have nothing in the middle, but everything above $150,000 has increased over 240%. It's gonna happen. It is gonna happen. We're just waiting for a correction to go ahead and hit. We have to wait quarterly because everything is on a delayed process. It's a delayed fuse in order for us to go ahead and see the housing market take a hit. First will always be the stocks, then it's going to be the economy, then the last is going to be the housing market. So if the stock market starts taking a shit, companies start doing bad, we have massive layoffs. At least I know we do in the real estate business. Mortgage companies, real estate companies, Redfin is dumping up a bunch of people, Zillow's dumping up a bunch of people, Loan Depot, mortgage companies all across the world, they're dumping a bunch of people, and it just is what it is. So to stay up to date, and to 50% commission rebate, 0% listing and selling your current home, or any mortgaging assistance, link in the description below. Like, subscribe, comment, all that other good stuff. Until next video, peace. I just got back from Vegas. I am so hungover right now. I feel like absolute shit. I don't know if it's because I'm 40 years old now and because it takes a long time to recover, but
I don't wanna waste a minute. Don't have any plans, wing it. If you got a glass, fill it, cause I need it now. Money is in it. I don't wanna think about it. So if you know the song, sing it, cause I need it now. Take me to a place where the music's loud. I don't wanna think right now. Flashing lights running through the crowd. I don't ever wanna stop. So let's get out. I got money in my pocket and I'm about to f***ing drop it with you now. With you now. Tear the roof off every building. I know I'll be spending millions with you. Just tell me what you wanna do. So let's get out. Let's get out. I got money in my pocket and I'm about to spend it all. I don't wanna waste a minute. Don't have many plans, wing it. If you got a glass, fill it, cause I need it now. Money is in it. I don't wanna think about it. So if you know the song, sing it, cause I need it now.